What's up, guys? This is Manoj Vapani. I welcome you all on behalf of the Edupedia world. It's been a fantastic morning outside, and I'm sure that you guys must be enjoying your life to the fullest, guys. So, guys, we have been discussing a few of the relevant questions which have already been asked in CE final examination for previous attempts with respect to the topic of leasing decisions. I hope by now you have already covered the entire questions which have already been discussed in our presentations for this particular chapter. The first two videos were solely dedicated towards the theoretical concepts, and the past three videos which we have shared were solely dedicated towards the kind of questions that have already been asked in CE final examinations. This is gonna be again a presentation wherein I'll be discussing with you guys some of the more kind of questions which have been asked in CE final examination with respect to the topic of leasing decision. So, are we guys all set? I hope you guys are in best of the health and spirit of yours. So, certainly, let's mark the beginning of this particular presentation with the first question of the day, and that will be ABC company has decided to acquire a rupees 5 lakh pulp control device that has a useful life of 10 years. A subsidy of rupees 50,000 is available at the time the device is acquired and placed into service. The device would be depreciated on straight line basis and no salvage value is expected. The company is in the tax bracket of 50%. If the acquisition is financed with a lease, then lease payments of rupees 55,000 would be required at the beginning of each year. Remember guys, beginning, just mark it in your mind. Then it says the company can also borrow at 10% repayable in equal installments. Debt payments would be due at the beginning of the year. Again, if in case we choose an option which is based on the borrowing option, then also we are supposed to pay the installments in the beginning of each year. Next, it says what is the present value of the cash outflow for each of these financing alternatives using the after-tax cost of debt. Which of these two alternatives is actually preferable? Without a doubt, we can say that the one in which we are supposed to pay less amount of money will obviously be preferred. So, guys, let's understand this question in order to get the clarity what it says. There is a company with the name of ABC. It wants to acquire an asset, which is here in this particular case as pulp control device. The cost of this particular pulp control device will be 5 lakh rupees. However, government is providing you the subsidy and which is 50,000 rupees while you will be acquiring this asset and placing it into your service. So what should be the amount which will be actually we'll have to shed from out of our pocket if I'll talk about, then it's going to be the net value which is 4,50,000. I'm getting a subsidy of 50,000, so I won't take the same into the account as far as my outflow is concerned. So it has to be 4,50,000. Next, it says that the depreciation will be charged on straight line basis. So since the asset is of 5 lakh rupees, if I'll talk about the depreciation with respect to next 10 years, it has to be 50,000 rupees for each of the year. Simple guys. And also it has been mentioned to us in the question itself that there is no salvage value. So we can't expect the same to be placed in our question. Also, it says that the company is in the tax bracket of 50%. So we'll have to take care of the tax saving aspect as well, because since interest as well as depreciation, both of them are tax deductible expenses, so we can easily save as far as our tax saving is concerned in this particular question, which is 50%. So we'll get the same while I'll tell you about the solution. Next, it says if in case we go for an option for leasing, let's suppose we get the asset on lease, then we are supposed to pay them the lease rentals. So what amount does the question provide you? The question provides you clearly that 55,000 rupees will be required to be paid at the beginning of each year as lease rental. And apart from that, if the company doesn't go for with an option of lease payments, then the company can also borrow rather at the 10% repayable interest rate in equal installments. Either way around, and we just need to find out which way should be chosen. I hope the same thing's absolutely clear to each one of you guys. Cool. Let's mark and go ahead with the solution part now. It says that the initial amount which needs to be borrowed is 5 lakh minus 50,000, 50,000 being the subsidy. So what amount should be borrowed? It has to be 4,50,000. Now, since 4,50,000 has to be paid and in totality with respect to the cost of this asset, which is the pulp control device, we need to find out what should be the annual payment, what should be the annual installment that we are supposed to pay each year with respect to this particular asset. And this can be identified and calculated easily with a simple concept, which is what is your initial amount which you are borrowing, that is 4,50,000, and you will have to divide it from the present value interest rate factor of the provided interest rate. In this particular case, the same is 10%. And since you need to understand this, guys, that the installment amount is being paid at the beginning of the first year, beginning of each year. So what we need to take care of is that the year will start not from 1, it will start from year 0. Why? Because I'm making the payment at the point of year 0 itself. That is my first installment. So how come we can get a figure of 6.759 with respect to the present value factor of all the annuities at 10% rate for 10 years? Here, this table will help you up. I have made this table solely in order to make you understand how come I came to a figure of 6.759. So it was all about with this particular table. Year, denominator, numerator, and what should be the present value interest rate factor annuity. So year will start from 0, then 1, then 2, then 3, and so on till ninth year. The denominator has to be different each year with respect to the multiplication of the element. For the first year, it has to be 1. Why? Because here I am making the payment in the first beginning itself. Also, the numerator for year 0 will remain same, which is 1. So accordingly, technically, we'll get the present value interest rate factor annuity for year 0 as 1 itself. Now the denominator will change each year. First year it has to be 1.1. Why? Because it's 10% interest rate. So 1.1. Next year it has to be 1.1 multiplied by 1.1, which will be 1.21. Then the same similar exercise needs to be done for each of the year, and you just need to multiply the numerator, the denominator with 1.1, and you'll get the figure for each of the year accordingly. Numerator will remain same in each of the year, so accordingly you'll get the present value interest rate factor for the next 10 years as 6.759. All you need to do is just divide 4,50,000, which is the initial amount borrowed from that present value interest rate factor annuity of 6.759. You'll get the annual repayment, annual installment payment that you are supposed to make in as rupees 66,578 rupees. Now, coming to the second part, which is schedule for debt payment. Guys, remember, since I told you this thing that we are supposed to make the payment at the beginning of the each year itself. So what is actually the amount of money which I'll be like owing to that company? If I talk about with respect to year 0, it has to be 4,50,000 minus 66,578. Why, guys? Because I've already made the installment amount at the initial year 0 itself. So what is the balance amount which is remaining? It has to be 3,83,422. So whatever kind of interest that I'm paying, I'll have to pay it on 3,83,422 rupees rather than 4,50,000. Clear, guys? Good. Now let's move towards the schedule for debt payment. You can see I've prepared a table over here which is involving 4 different columns. Number 1 is year end. Number 2 is total payment. Number 3 is interest. And number 4 it's principal amount outstanding. If I'll talk about year end 0, the total payment that I'm making at the first beginning initial payment, it has to be 66,578. In this case, the interest amount is 0. I am making the payment, the first installment amount at the beginning of the year itself. As and when I was taking up the loan, I've already made it as a kind of down payment. So, should we charge interest rate on that amount? Absolutely not. So, the principal amount which will be like outstanding will remain in as 3,83,422 once I've already made the payment of 66,578 out of 4,50,000. Now, coming to the year end 1. So now, this is the time wherein I have to charge interest. Why? Because I've already taken up the loan at the beginning of the year. Now it's year end. So interest will be charged on it. And since in the question, it has been mentioned to us that the bank will be providing us loan at 10% interest rate. So The principal amount which was outstanding at year end 0 was 3,83,422 rupees. I'll charge an interest of 10% on this particular amount and I'll get the interest figure as 38,342. Since I am supposed to make an annual payment of 66,578 each year, this will be the total payment that I'll be making at year end 1. Out of the same, 38,342 rupees is directly relating towards the interest. So, what is the remaining amount? The remaining is my principal repayment. And once I'll be getting this figure of principal repayment that I'm making out of 66,578 rupees after deducting the interest, then the balance will be my principal amount outstanding for year end 1, which will be 3,55,186 rupees for year end 1. Similar exercise needs to be repeated. Now I'll be charging an interest of 10% on 3,55,186, and that will be my interest for year end 2, which I have stated in this schedule. Thereby we'll get the figure of remaining principal amount for year end 2 as 3,24,127 rupees. This exercise needs to be repeated till the end of year 8th. Now if you can see guys, year end 8th, the principal amount outstanding amounts to 55,023 rupees. Now, we are supposed to make a total payment of 66,578 rupees. Also, it includes some amount of interest that is supposed to be paid, which was basically 10% of 55,000 rupees. So I'll get 5,500 rupees as an interest. And till the time we are like completing the principal payment outstanding figure for year end 9, you'll get a figure of nil over here. Why? Because entire principal amount of 55,000 will also be paid in the total payment of 66,000 apart from some other miscellaneous amount relating to the interest. That's it. So this was the entire schedule of debt payment. Now, why is it important to calculate and prepare the schedule of debt payment? Why? Because guys, we are supposed to find out the present value of the cash outflows. You cannot in any of the case get this figure if in case you haven't find out the amount of interest that you are paying off while in the schedule of debt repayments. So here, since in column number 3 I've already calculated the interest amount that I'm paying, that is 38,342 for first year, for 35,519 for second year, and so on till 5,500 rupees for last year. This will be exactly shown in my next table, which will be relating to your main question, which will be schedule for cash outflows. This with regarding to the borrowing option. If in case I go out with an option of having for debt alternative, so what should be the case in this particular scenario? The same table I have like dedicatedly distributed it into 8 different columns. First column is the year. Second column is the amount of installment that I'm paying off, debt payment. So that is same in each of the next 10 years. That is 66,578 rupees. Coming to the third column, it states about the calculation of the interest which we did in our last schedule of debt payment, which we have just completed. Next will be the depreciation amount. Depreciation has to be same for each of the next 10 years because the question itself says that depreciation will be charged on SLM basis. So it has to be 5 lakh rupees divided by 10, 50,000 for each of the years. Coming to the fifth column, it says about the kind of tax saving you do while charging off your interest and depreciation in this particular question. Interest and depreciation are two tax deductible expenses. So you'll get the tax saving of 50% here in this particular question itself. Now, after deducting your tax saving out of the debt payment amount, you'll get the net cash outflow that you'll be shedding out from your pockets. The same has to be multiplied with present value factor NVT at the rate of 5%. 10% was the before tax. You need to multiply it with your 50% taxation rate. You'll get the present value factor NVT at 5%. You'll have to multiply all of these cash outflows with their respective years present value factor annuity. So you'll get present value for all the years outflows, which in this particular question it will be totaling 2,57,176. Now let's understand it one by one. Guys, year 0. The debt payment is of rupees 66,758. Does it include any amount of interest? Absolutely not. This is something which I have already paid in the beginning of the year itself. So it will not include any amount of interest. Number two, does it include any amount of depreciation? Absolutely not. Again, this is something which I have paid in the beginning of the year itself. So I haven't charged any of the depreciation as of yet. So whether I'll be getting some kind of tax shield in this particular scenario? Absolutely not. I'll have to take care of net cash outflow, which is 66,578 rupees in year 0. I'll multiply the same with present value and factor at the rate of 5%. In this case, since the year hasn't been elapsed till now, and this is something which I'm making the payment in the beginning of the year itself, it has to be counted as 1. I'll multiply the same with the net cash outflow. I'll get the present value factor amount as 66,578 rupees. Now, coming to year 1, the debt payment for year 1 will be 66,578 rupees. Now, guys, since we have calculated the entire amount of interest in schedule for debt payment in our last slide itself, we'll be pasting the exact figures in this column. Year 0 interest will be 0, and for the next 10 years we'll have like directly pasted the figures which we calculated in this schedule for debt payment here. Once after you'll put all these things here itself, you'll have to take care of the depreciation part. Depreciation has to be same for each of the years. It has to be 50,000 for each of the years. Now you'll get the benefit of tax saving in these two aspects. Number one, interest. Number two, depreciation. So the tax shield for interest plus depreciation multiplied by 50% for each of the case, you'll get 44,171 for year 1, 42,759 for year 2, and so on till 27,751 for year 9. I'll take care and tell you something related to year 10, but before that you need to understand what goes through from year 0 till year 9. Then, after getting this tax shield, all you need to do is just subtract the amount of these tax shield from your debt payment. You will get the figure of net cash outflow, which will be shedding out of your pockets. Multiply the same with the present value factor annuity at 5%. You'll get the present value for the first 9 years. Now, coming to the crux, which is with relation to year 10. Guys, we have already made the payment in the beginning of the year itself. Okay, so for the year 10, I won't be shedding out any of the money at year end of 10th year. Why? Because I have already made the payment in the beginning of 10th year itself. So the debt payment for year 10 will be 0. Since the debt payment for the year 10 is 0, there is no scope of getting the principal or interest amount here in this particular case. Absolutely not. So the interest amount will be 0. I've already made the payment beforehand itself. But depreciation is something which will be charged at year end. So what benefit I was not able to get in year 0, I'll get the same benefit here in year 10. So 50,000 will be charged in as depreciation, my remaining depreciation amount. So since that is the amount of depreciation which I'll be charging in the books of accounts for year 10, the tax shield which I'll be like able to get and extract out of it is 50% of 50,000, which is 25,000. So what is my net cash outflow for year number 10? It has to be negative 25,000. I'll multiply the same with the present value factor at 5%, which is 0.614. I'll get the present value in as negative 15,350 rupees. And overall, after summing up all these 10 years cash outflows, I'll get the present value amount for total outflows 2,57,176 rupees. I hope you guys are pretty much clear with the debt alternative. Shall we proceed further, guys? Let's go ahead and understand what this question has to offer with respect to the leasing. So guys, this is about the leasing alternative. It says I've like divided this particular presentation, this particular schedule into 6 different parts: year, lease payment, tax shield, cash outflow, present value, interest rate factor, annuity at 5%, and the present value. So guys, for year 0, it has been told to us that we are supposed to make the installment amount, the rental amount in the beginning of the year itself. So year 0, we need to make the lease payment 55,000 rupees. But since I haven't booked the expense as of yet, booking of expenditure basically happens by the end of the year. So since I haven't booked this expenditure in my last year, the tax shield that I'll be like able to get for year zero, because I have made the it as a kind of a down payment, the tax shield will be zero in this particular case, and entire amount will be counted in as cash outflow, which is 55,000 rupees. Present value interest rate factor at the annuity of 5%. Again, this is the same thing. 10% multiplied by 50% of taxation rate, you get a present value interest rate factor at a rate of 5%. You'll multiply the same with 1. Why? Because year 0 PVIFA for 5% will be 1. You'll get the present value in as 55,000 again. Now, it's a very simple kind of a thing wherein for year 1 to 9, the lease payment amount will be 55,000. And since the lease rentals, whichever you are paying off as lease amounts, this is something which is a kind of a tax deductible expense. So you'll deduct the same and you'll get the cash outflow of 27,500 rupees. Multiply the same with the present value interest factor annuity at 5%, that is the summation of the year 1 to 9, that is 7.109. You'll get the figure of 1,95,498 rupees. Coming to the last year, which is year number 10. Are we paying any kind of lease payment in year 10? Absolutely not. We have already made the payments, the entire payments from year 0 till year 9th. So, but since I have made the payment in the beginning of the year itself, however, having said that, I can book my expense which is belonging to year 10 only by the end of year 10. So, here I'll get the benefit of tax shield. I have booked my expenditure in the books of company for year 10 completely, and the tax shield will be 50%. So that is gonna be 55,000 multiplied by 50%. You will get the figure of 27,500 rupees as tax shield. So the cash outflow for year number 10 will be negative 27,500. The same has to be multiplied with 0.614, which is the present value interest factor annuity at 5% for year number 10. You'll get the present value in as negative 16,885. If you'll calculate and sum up all these amounts, you'll get the total present value of outflows as 2,33,613 rupees. Now, calculate, guys. Present value of the cash flow under debt alternative was 2,57,000. Here, if in case we chose the option for lease alternative, we'll have to shed only 2,33,000 from our pockets. So, which option is preferable? Obviously, the one wherein we are supposed to pay less amount. The conclusion, lease option is preferred. I hope you guys are utmost clear with the kind of concepts which we are telling you up with respect to borrowing alternative and leasing alternative. I hope you guys are clear. Sure, guys, let's move ahead with the next question. This question was again asked in CA final examination. So it says, Agrani Limited is in the business of manufacturing bearings. Some more product lines are being planned to be added to the existing system. The machinery required may be bought or may be taken on lease. The cost of the machine is rupees 40 lakh, having a useful life of 5 years with a salvage value of 8 lakh rupees. The full purchase value of the machine can be financed by 20% loan repayable in 5 equal installments falling due at the end of the each year. Alternatively, the machine can be procured on a 5-year lease basis, year-end lease rentals being 12 lakh rupees per annum. The company follows WDV method of depreciation at the rate of 25%. The company's tax rate is 35% and the cost of capital is 16%. We are supposed to advise the company which option should it choose, lease or borrow. We need to assess the proposal from the lessor's point of view, examining whether leasing the machine is financially viable at 14% cost of capital or not. So guys, this is the question. And in a nutshell, I can simply say that the cost of the machine is 40 lakh rupees. Salvage value at the end of fifth year will be 8 lakh rupees. Then it says that the entire machine can be procured on borrowing basis with the help of 20% loan interest rate, which has to be repaid in 5 equal installments, and the installments will fall due, guys, in the end of each year. Alternatively, it also says that whether we can go for another option, which is taking a 5-year lease, and the year-end rental for each of the year is gonna be 12 lakh rupees per annum. Also, it says that the WDV method has to be applied as with respect to calculation of depreciation. in this particular question, and the rate will be 25%. Apart from this, we have been told that the taxation rate which is applied to the company is 35% plus the cost of capital is 16%. So now we need to find out whether we should go ahead with leasing or borrowing option. Let's understand this question completely with a better clarity, and it will be with this solution. So guys, let's understand with a simpler one, and which is the present value of the cash outflow under lease option. This is simple, utmost simple, and which says for year 1 to 5, the lease rental after tax, it has to be 12 lakh rupees before tax. But since we all know that the lease rental, whichever amount you are paying off, this is something which is a tax deductible expense and you can charge it off in your profit and loss account. So we'll multiply the same with 1 minus 0.35, which is the taxation rate. So what has been my lease rental after tax, which I really have to shed out of my pocket? It is nothing but 7,80,000 rupees. I'll multiply the same with the present value interest rate factor annuity at 13%. Remember guys, before tax, present value interest rate factor annuity is 20%. I'll multiply the same with the taxation amount, and after the same, I'll get a figure of 13% in this particular scenario. So present value interest rate factor at the rate of 13%, it will be 3.517. I'll multiply the same with 7,80,000. I'll get a figure of total present value in as 27,43,260 rupees. This is what we'll get a figure if in case we would have resorted towards leasing option. Now, coming to the cash flow option under borrowing. Borrowing, it simply says, guys, we are supposed to make the installment amount with respect to the principal, which is 40 lakh. 40 lakh was the cost of the machine. Now, I'll have to divide it from the present value interest rate factor annuity at 20%, which comes out to be 2.991 for 5 installments. That is for 5 number of years. Herein, you'll get that we are supposed to make an equal installment amount of 13,37,345 rupees for each of the year. This is with respect to this thing. Now, we'll move towards the tax advantage part. Not now, but beforehand, we need to understand what should be our working notes in order to go forward with it. Now guys, the first one is going to be the debt and the interest payments. I have divided this particular schedule into 6 different columns: year, then loan installment, then loan at the beginning of the year, then comes interest, then comes principal amount, and then comes finally the balance at the end of each year with respect to principal amount outstanding. So for year number 1, the loan installment amount is 13,37,345 rupees. We just calculated it. That will remain same for each of the next 5 years. Now coming to the second part, which is loan at the beginning of the year. Remember guys, the cost of the machine is 40 lakh rupees. So I have opted for a loan for complete 40 lakh rupees amount. This is the loan amount which is at the beginning of the year. Now since it has been told to us in the question itself that we are supposed to charge 20% interest on the loan amount. So for 20% loan on 40 lakh rupees, it has to be 8 lakh rupees interest for first year. Now, since 13 lakh 37,345 rupees installment amount includes an interest of 8 lakh rupees, what should be our principal amount of the same? It has to be 5 lakh 37,345 rupees. This will be the remaining amount, which is the principal amount that I'll be paying off in that first installment. Once you'll be paying off this principal of 5,37,000 out of the loan which was available at the beginning of the year of 40 lakh rupees, you are left out with the balance at the end of the year remaining principal outstanding in as 34,62,655 rupees. Now you'll have to charge the interest of 20% on this figure, which is 34,62,655 rupees. So you'll get a figure of 6,92,531 rupees. Once you'll be charging this amount, you'll get a figure of 6,92,531 rupees. This will be subtracted from the total loan installment amount of 13,37,000. You'll get the figure of principal repayment in as 6,44,814 rupees for year 2. Subtract the same from the balance at the end of year for year 1. You'll get the balance at the end of the year 2 as rupees 28,17,841 rupees. Similar exercise needs to be repeated for year 3 and year 4. And finally, what you'll see is that the balance at the end of year fourth will be 11 lakh 15,532 rupees. That is the balance amount. So you'll charge the interest on this amount. You'll get the figure of 2 lakh 21,813 rupees. This is something which is inclusive in the total loan installment of 13 lakh 37,345 rupees. So if it's inclusive, then the balance amount has to be the principal, which is nothing but 11 lakh 15,532 rupees. If the entire payment of this principal has been made in the loan installment of fifth year, then the balance at the end of year fifth will be zero. Sorted, guys. This was about the debt and the interest payment. Coming to the second part, which is about the depreciation. Year and depreciation it has been provided to us in the table. I have like prepared this table in order to make you understand this thing with complete clarity, because this question asks you up for WDV method, and there is a possible chance wherein you can get confused with respect to the charge of depreciation on WDV basis. So this is the best kind of a presentation which you can show your depreciation schedule. So for year one, it has to be 40 lakh rupees, which is the cost of the asset. Multiply the same with 25% depreciation for that year, which comes out to be 10,000 rupees. Deduct the same and you'll get the next year's figures WDV in as 30 lakh rupees. Multiply the same with the depreciation rate, which is 25%. You'll get a figure of 7 lakh 50,000 as a depreciation of year 2. You need to subtract this amount and you'll get the WDV for year 3 beginning, which is 22 lakh 50,000 rupees. Multiply the same with 25, you'll get 5 lakh 62,500 for year third depreciation. Repeat this exercise for year 4 and year 5. Finally, what you'll see is that the book value of the machine in this particular scenario at the end of year 5 is actually will come out to be 12,65,625 rupees minus 3,16,406 rupees, which is the depreciation for year 5. The final WDV which is available in the books of accounts after charging the depreciation of fifth year will remain in as 9,49,219 rupees. Why have I calculated this last thing? Because you also need to find out the present value of the saving that you will be taking up with respect to capital gain or loss while you'll be selling off this machine. Coming back to the tax advantage table. Now guys, year end, that is 1, 2, 3, 4, 5. Loan installment, it will remain same for each of the 5 years. 13,37,345 rupees. The interest amount has been like calculated in this particular debt and interest payment itself. Interest amount for first year is 8 lakh, 6 lakh 92, 531 for year 2 and so on till the year 5. So what's going to be the tax advantage, guys? Taxation rate has been provided to us in the question as 35%. So 8 lakh multiplied by 35%, you'll get a figure of 2 lakh 80,000 for year 1, 2,48,386 rupees for year 2, and then comes for third year, then comes fourth year, and for fifth year it has to be 77,635 for year 5 with respect to the same thing which we applied for year 1 and year 2. Now also in the question we have also already found what should be charged as the amount of depreciation in each of the 5 years. It has to be 10 lakh for first year, 7 lakh 50,000 for second year, 5 lakh 62,500 for third year, and so on. The same needs to be multiplied with 35% for each of the year's taxation. You'll get the tax saving, which is 3 lakh 50,000 for year 1, 2 lakh 62,500 for year 2, and so on. For similar exercise needs to be repeated for year 3 and year 4, and accordingly you'll get the figure of all these 3 years. Now, since I have obtained the figure for tax saving on interest and depreciation, I just need to deduct the same amounts from loan installment. I'll get a figure of net cash outflow for the remaining 5 years, all 5 years. Multiply the same with respect to with the present value interest rate factor annuity at 13%, and you will get the total present value for each of the 5 years. The total present value for each of the 5 years will sum up to 31,92,227 rupees. You need to subtract the present value salvage value adjusted for tax saving on loss of the machinery. Guys, this machine was sold at a price of 8 lakh rupees, but what was the actual WDV amount at the end of 5 years? It was 9,49,219 rupees. So this machine was sold basically at a loss of 1,49,000 rupees. So you'll get the benefit of this as well in your taxation aspect. So multiply the same with the present value interest rate factor annuity for fifth year, which is 0.543. multiply the same with it, and you'll get the figure of 28,359 rupees. You'll add this particular amount with 4,34,400, which is actually the present value, the salvage value which you'll get. So this is the amount of tax saving on it, and plus add the same to the salvage values present value amount, you'll get the total figure of 4,62,759. Now, since this is your cost saving, you're not charging anything of it, and it is basically your tax saving, your cost saving. So you will deduct the same with your from your present value amount of outflow. You'll get the total present value of the cash outflow final in as 27,29,468 rupees, if in case you would have gone for an option of borrowing. Now guys, if in case you would have gone for an option of leasing, you would have been required to pay 27 lakh and 43,000 under lease option. But as far as the borrowing option is concerned, you are supposed to shed out a money which is 27 lakh and 29,000. Now, which is the better option? Obviously, with respect to borrowing, herein you are supposed to pay less amount of money as compared to what you would have to, had it been the case, you would have chosen an option for lease. So this is something with respect to the first part. Coming to the second thing, we need to provide them the proposal with the viewpoint of lessor, whether lessor should go ahead with it or not. The only time lessor is satisfied with the agreement is when he is actually getting something which is beyond the cost of the asset. Simple guys. So lease rentals for each of the 5 year, it has to be 12 lakh rupees. We need to subtract the depreciation amount because depreciation is a non-cash expenditure. So we need to subtract it, and plus it is also it is an expense which we charge in our books of accounts. So what we need to do is, at the first option, we need to subtract the depreciation amount in order to get the earning before taxes amount. So for each of the 5 years, we need to subtract the depreciation amount, which is 10 lakh for first year, 7 lakh 50,000 for year 2, 5 lakh 62,500 for year number 3, 4 lakh 21,875 for year 4, and 3 lakh 16,406 for year 5. You will get the EBT, that is earning before taxes, for each of these 5 years. Now multiply the same with the taxation rate, which is 35%, and then subtract that amount. You'll get a figure of EAT, which is earning after taxes, in each of these 5 years. Now all you need to do is just add back the depreciation which you deducted in the first step itself. You need to add back. Why? Because depreciation is a non-cash expenditure. So this is something which you are not supposed to shed out each year out of your pocket. You have already purchased the asset. That was a one-time expenditure. Now depreciation has to be added back in order to get the cash flow after tax. So for first year, it's going to be 11 lakh 30,000, 10 lakh 42,500 for year number 2, 9 lakh 76,875 for year 3, 9 lakh 27,656 for year 4, and 8 lakh 90,742 for year number 5. Multiply the same with each year's present value factor for at the rate of 14%. You'll get a figure of present value for each of the 5 years. Sum up all these and you'll get a figure of 34,63,551 rupees. Now, since you are the owner of the asset, guys, you need to understand that you will be better off in a situation of tax saving on the sale of asset as well. So whatever amount which was charged, like in order to get the figure of the selling price minus WDV of the asset on that particular day. So this is something with respect to that particular amount, and you'll have to multiply it with your 35% taxation rate. You will get the tax saving on the sale of the asset in as 27,106 rupees. So what is the total present value of the cash inflow that you'll get? It is 34 lakh 90,000 rupees. And what was the cost of the machine? It was 40 lakh rupees. So should I go ahead with this particular proposal? Absolutely not, guys. I have to charge and I have to pay 40 lakh rupees, and in return of it, in consideration, I'll receive only 35 lakh rupees. No point. Absolutely no point. Lease rate is lease rental option is financially not viable for the lessor, so which is not recommended. So this is what being done in this particular question. I hope you guys got the complete clarity with respect to each and every stuff which I told you for these two questions. All you need to do is just revise the topic, guys. Whatever the kind of things which we are doing on behalf of Edupedia, my efforts, all these things will go in vain if in case you don't study and you don't revise. So do revise your topic, guys. I'll see you in the next presentation with a lot more questions waiting for you up. Keep interacting via questions, queries, and YouTube comment boxes. I would love to answer each one of your queries and grievances, guys. If in case you have liked this video, if in case you find this video knowledgeable, then do share it with your friends, guys. Keep pouring your love. This is something which is immensely required for each one of us. Stay connected. I'll see you in the next presentation with a lot more questions. Till then, sayonara. God bless you all. Take care. Bye, guys.